Okay, everybody, thank you for your time. We were just giving people a chance to move between some of the other sessions, so thank you for your patience. For those of you who just listened to me, you know who I am. I'm Russ, Mould Bell's Investment Director. But more importantly, on my left, on your right, I've got Gareth Evans, Managing Director of Progressive Equity Research, and Michael Hewson, our Chief Market Analyst at CMC Markets. And we're here today to answer your questions about hot sectors. I'm going to introduce the guys in a minute, let them tell you how wonderful they are and how wonderful their firms are. I'm then going to make a couple of introductory comments, and then for the remaining 33 minutes or so, we're going to throw this open to your questions for the panel, so please don't be shy, because if you are shy, I've got a list of really easy ones written all the way up here, and it's not going to be anywhere near as instructive or educational for you as it would be otherwise. So I'll start with Michael, please.
Morning, ladies and gentlemen. My name is Michael Hewson. I'm Chief Market Analyst at CMC Markets. I've worked in the city 25 years, trading and educating people in how to use price charts, technical analysis, that sort of thing. I've been at CMC Markets 10 years. I'm in charge of the analysis and research part of the business, but I'm also responsible for teaching investors like yourself, traders as well, how to interpret price charts, price trends, when to go into a market, when not to go into a market, and hopefully develop decent risk management strategies. So hopefully in those 25 years I've learned something that I can impart on, with you today.
Gareth.
Good morning, my name's Gareth Evans. I'm an equity research analyst. I started my career in the city just over 15 years ago at a large American bank called DLJ, Donaldson, Lufkin and Jenrette, where I covered the pan-European chemical sector. And in the chemical sector, I spent a couple of years learning from some very clever people the most important things about investing related to cost of capital, hurdle rates, and return on investment, some of the themes that Russ was talking about earlier. Then I moved to ABN AMRO. This was the height of the dot-com boom, and I was in the pan-European internet sector, covering a number of dot-com stocks. And I learned from some equally clever people that cost of capital, hurdle rates, and return on investment were completely irrelevant, and what mattered were number of page views, clicks, and increase in numbers of registered users. I think I've spent the last 12 or 15 years trying to reconcile those two, and I've worked out that the reality is that most investment cases lie somewhere between those two extremes. I've spent a lot of time working with small mid-cap stocks. I was head of research at Investec, where we had a team of around 30 analysts covering 14 sectors. More recently, I've set up my own business, Progressive Equity Research, helping smaller companies get their message across and helping smaller investors hear about and learn about stocks that would otherwise be the preserve of larger institutional investors.
Donaldson, Lufkin and Jenrette, there's a name from the
Easy
past.
to say.
And I can beat that because my first ever business card said SG Wahlberg incorporating Arkwan, Mullen, Smithers, Rowe and Pittman. So there you go. That's how old I am.
A long business card.
Yeah, exactly. So just a couple of very brief introductory comments. We've seen this, but we've got to be all very aware of it. This is until Monday. I think Michael's got a more up-to-date version on his iPad. This is the UK FTSE All-Share, the best 5 and worst 5 performing sectors in the year to date so far. Forestry and paper, construction materials, household goods and home construction, software and non-life insurance. That's a big takeover story you've seen Amlin there bid for just this week. And the worst performers, electricity, oil and gas, auto and parts, which is mainly GKN, interestingly, mining and, surprise, surprise, industrial metals and mining. So no great shock there. An interesting collection there. I always just throw this up because I've always been a great believer that a bad stock in a good sector will generally outperform a good stock in a bad sector. So if the force is with a particular sector, a lot of stocks will, in the short term, be carried along for the ride. In the long term, as I discussed in the previous session, you still need to look at the fundamentals of that particular industry. And then just doing this on a global basis, this is the S&P 1200, based in dollars. Only one global sector is now up year to date, healthcare, where there's all the demographic trends. There's also a lot of short-term M&A, and then varying degrees of declines elsewhere, with, again, surprise, surprise, oil and mining right down at the bottom. So that's the current backdrop for where we are. Who is now going to be brave and ask the first question? Thank you, gentlemen there. Just wait for the microphone, please, so everybody can hear you, and then we'll gladly take your question. Blaze away, sir. Thank you.
Could you tell me what's your best leading indicator for a stock? Is it too late by the time you get to the first profit warning?
Good one. Who wants to take that? Gareth? Tech stocks are quite good at profit warnings, aren't they, sometimes? So.
Tech stocks are great at profit warnings. They can be really quite cataclysmic, and I've seen a few of those over the years. I think the leading indicators, I had the privilege of writing research on ARM for a number of years at Investec, And I thought that was a fantastic business in some of the ways that Russ has described a number of the qualities that you look for in a business. And what was clear to me was that those qualities in terms of admirable management, in terms of clarity of disclosure and lack of exceptionals, they were combined with a number of competitive and comparative advantages that were there for the long term. So they had a structurally strong position. They designed the core microprocessor designs that went into the vast majority of the world's phones, and they were harvesting that revenue very, very strongly. So I think in terms of lead indicators, looking for those sorts of things building up, looking for the positives coming together strongly is the way to do it. Clearly, when you see the absence of that's when then I would start to worry. If you see a business which is priced on the basis of historic dominance of a position, and those areas of dominance are starting to erode, either in terms of the market itself slowing down or in terms of competitive pressures rising, look for those sorts of signals and a management team who's keen to hide those rather than admit them, acknowledge them and go on to address them. Those are the sorts of things I try to look for in terms of positive or negative leading indicators. Does that answer the question?
You're welcome to join in, Michael.
No, absolutely. I mean, I actually think that sometimes just reading the newspapers, you can give a good indication as to whether or not you're going to get a profit warning. And I'm going to use Tesco's as a case in point. I mean, you look at what the share price has done 4 or 5 years ago, it was a great income stock and it was number one in the supermarket sector. But even if you look at the generally, what's the word I'm looking for? The regular updates that we get from Kantar World Panel and market share indications, you could see straight away that Aldi and Lidl and all the cheaper, what I would call lower bargain basement supermarket brands were starting to eat into its market share and start to erode its margins. That would then suggest to me that the price of the stock itself was starting to look a little heavy, and the fact that the management didn't adapt to that would lead me to suggest, well, maybe Tesco's is starting to get a little bit too big for its boots. And that is exactly what's happened. You look at the share price of Tesco's, and now everyone's thinking, you know, how low can it go? It's the same for Morrison's. Again, they were behind the curve when it came to the internet and adapting to that. And now they're starting to buy all these local stores, which now they've realised they don't need because they came too late to the party. So, you know, it's not just about the first profit warnings. There are red flags leading up to that, which you sort of alluded to in your initial presentation.
What I would say on the first warnings, it's not always too late, because you very rarely only find one cockroach. You know, you'll often see that, you know, profit warnings do tend to come in clumps, and things, particularly with companies with high operational gearing, when their sales start to drop, that's when things can run away from a management team quite quickly. What you then need to work out is it just a cyclical impact? And it could be, or has management dropped the ball? If something's gone seriously wrong, the model's broken, the industry's changed, then you've got a big decision to take. If it's just a cycle going down, well, that's what I know central banks are trying to work out a way of making sure there is no recession in the future. Well, they're in for a nasty shock. There always will be. And then it's a matter of how management responds to that. Is the business financially sound? You know, VP didn't enjoy itself during the recession by any means, but it was financially sound and was positioned for the upturn when it came, and people have reaped their rewards. So I think that's what I would always say. With a highly operationally geared company, if there's one, there's probably another one or two potentially coming. It's a very good question. Next, one from the gentleman in the middle there, please. Oh, and then one from, I think, a lady at the back. Sir, thank you.
The large majority of the indicators to watch out for in the green flag you mentioned earlier on, the large majority of them are quantitative financial metrics that you can actually use to measure the performance of a company. But the last one, which is about the strength of the management,
yes,
the good governance and the track record. Most of them in their financial reports, they will always put that they stick to corporate governance and the rest of them. But how can you actually, get these facts? How can you lay your hands on this actual fact to actually know that this particular company, you can actually get their track
Gareth,
record?
I'm sure you read a lot of report and accounts and have the privilege of meeting a lot of management teams one-to-one.
Sure. It's a very good question, and I think it's probably one of the hardest aspects of investing, especially for the smaller, the retail investor who doesn't perhaps have the privilege of access to the management teams in the way that the big city institutions do. So I would suggest spend as much time as you can. Yes, looking through the report and accounts, you want to make sure they do adhere to the governance codes and so on, and that, I suppose that's a necessary precursor. They have to do that as a bare minimum. But I would suggest looking for things over and above that. A very clear website telling you exactly what the company does, talking about the management team and their own backgrounds in terms that you understand, explaining the business model. I think it's also important to look at the annual report and make sure that you understand the different divisions of the business, that they're very clear about the strategy for the group as a whole, and that you can understand all of the different elements of the business, both in terms of the way that the business is run and the people that are running it. And I think the clearer and more concise they make that, the better it suggests the way they're running the business, but it also suggests that they're taking their responsibilities to investors seriously. I'd suggest go to the website. If you can't find the investor relations section of the website from the front page of the website, then there's something wrong. If it's difficult to locate it, or once you have found it, if it's out of date, you've got a calendar of events that might be 2 or 3 years old, there's no reports or accounts, there's no presentations on there in the way they should be, I would suggest that sounds like a management team who aren't that interested in the city and aren't really doing all they can to help investors become educated. So those are the sorts of softer points. But I agree with the question. It's a very difficult thing to get your head around because there aren't so many quantitative points you can look to.
Anything you want to add, Michael?
Yeah, absolutely. I mean, in the last 10 years, one of the great things about the internet has been the availability of online information. And for me, whenever I want to find out about a company, first place I look is these general websites like ShareScope, like Digital Look, for example, where all of that information is aggregated together. And if I want to find out about a particular member of management, I just Google them and then look and scratch around behind the scenes. You can't hide anything now on the internet. You'll always find something that will either reinforce your perceptions of a company or maybe even confirm your suspicions. So for me, there's no substitute for good research. If you're unsure about a particular company, don't touch it.
Question right down here, one at the back and then one right at the front, please.
You've got good eyesight.
Question here. Thank you. Thank you, madam.
Yes, thank you very much. Gentlemen, what would each of you say if I say that no matter how much you have all this information, your green flags, your red flags, share scope, what have you not, if you sit daily and you look at the share price, the final decision to buy a stock or not is a gambling. And you can say it is informed gambling or less risky gambling. It does remain a gamble whether you buy or not.
Can I jump
Yeah,
in?
jump in. Risk management, I think, is the topic.
Risk management. Well, basically, getting up and going to work is a gamble. You might get hit by a bus. You miss your train. You know, life is full of gambles. And to my mind, if you're investing, investment is all about risk management, doing your research. You are never going to mitigate 100% risk. It's never going to happen. What you can do is mitigate that risk so that if, for example, the bet or your investment goes wrong, then at least your losses are fairly confined. What's also important is to have a balanced portfolio. Don't expose yourself to one particular sector, or don't overly expose yourself to one particular sector. The banking crisis is a case in point. If you were too heavily geared to banks, obviously you would have been hurt that much more. So having a broadly balanced portfolio across cyclical sectors, but as well as income sectors, will insulate you from the worst of any potential market volatility. And over the course of the next 5 or 10 years, you will probably come out ahead.
Gareth?
I completely agree. I mean, obviously there are ways you can mitigate that risk. If you're looking for the investment returns that equities can deliver, and as Russ showed, there are some great returns that have been made historically. If you're looking for those kinds of returns but don't want to take the risk yourselves, obviously there are all sorts of fund management organisations who can aggregate those risks or try and mitigate them by spreading them across large portfolios on your behalf. But yeah, I think to the earlier point about information and availability of detail through the explosion of technology and the internet and so on, I think it's now much easier to make investment decisions yourself because there's a lot more to go on. But it's also harder because there's a lot more to go on. So it is a balance.
There's no information asymmetry anymore in
exactly.
In some ways. So.
And also what you've got is that you've got stock markets that are being distorted by central bank stimulus. So you look at an awful lot of stocks, and I'll give a US stock as an example, Netflix. It's trading on forward earnings of around about 450 times. Now that presupposes that it's going to wipe out all of its competition and the rest over the course of the next 3, 4 or 5 years. That is simply not going to happen. That's trading at the moment higher on momentum and herd behaviour. Is it sustainable? No. But ultimately, and I think Warren Buffett touched upon it, you know, you'll get wiped out long before the market crashes on a particular stock.
I think the way you can defend yourself is by valuation and building in a margin of safety, and then you're not gambling. And I know it's an extreme example, but when Michael and I go to the Duke of York pub over the road after this session's finished, and I was to have a pint of lager shandy, and I got all excited, and I offered to sell Michael this pound coin for 80p, he'd probably be quite pleased. If I had a second pint of lager shandy and offered to sell it to Michael for 60p, he'd be making a bigger profit, yet he'd be taking less risk. So it's all about assessing the valuation that you're paying for it. It doesn't have to be bargain basement like that, but as Benjamin Graham said, Mr. Market will knock on your door every day and say, madam, you can buy Netflix at $450 today, $400 tomorrow, $150 next week, and $600 the week after, and you can make that choice. And if you get the right valuation and build in a margin of safety, even if things do go wrong, the share price won't go down that much, then you are protecting yourself, and then you're not gambling, then you're investing because you're managing risk. Does that help? A bit. Well, find us on the stands, we promise. Question right at the back, please, then one at the front, and then one there, and then one right at the back. Right here, sir, and then one at the front, then one there, and then back to you.
Hi, I'd just be interested in your view on the relative importance of both technical analysis versus fundamental, and also active versus passive investing.
Technicals, Michael, away. You've got 13 minutes.
13 minutes, is that all? I could say come and see me afterwards. I use a combination of both, certainly in terms of short-term trading. Long-term trading, technical analysis isn't as that important, but I don't know whether you've heard the adage, never try and catch a falling knife. I think even if a company is cheap, it doesn't necessarily mean that it can't become cheaper. So if a market is falling, say for example, and I'll use Centrica as a decent example, that particular stock has been in a downward trend since 2013 when Mr. Miliband first announced his energy price freeze, or was it a cap? I can't remember. Proposed. So obviously that would have hurt Centrica if Labour had been elected in May. That being said, the price has still continued to fall, but actually when I look at the technicals and I look at the fundamentals, I look at that stock and I think, well, yes, it made a loss last year. That was an exceptional item, at least I hope it was. It's still yielding 5%, and revenues going forward look to be coming in around about 29 or 30 billion pounds. So not that different to the last 3 or 4 years. So that suggests to me that potentially maybe there's a decent opportunity to buy that particular stock. That's where technicals come in. I look at the previous price history, I look at where it was trading 4 or 5 years ago, and if it's near those lows, then my risk reward is fairly low, because if it drops below the lows of 3 or 4 years ago, then I'll revise my opinion of that stock, because on that basis, fund managers could actually offload that stock because it's dropped below a key support level and could continue to go lower. Similar sort of story with respect to mining stocks. Are they cheap or are they expensive? Technicals can help in that regard. You look at BHP Billiton, again, that's been trying to catch a falling knife, but it's still above its 2008 lows, and it is fairly cheap on a fundamental basis. The big question is, are you prepared to hold on to it, look through the short-term price swings, and take a long-term view, not only on BHP, but also Centrica, but also on commodity prices as a whole. So with Centrica, I look at the diversification of that business as well in the context of the technicals. Hopefully that helps. If you want me to expand upon that, more than happy to talk about it after this session.
2 fundamental bottom-up analysts. We might be a bit biased.
Potentially.
Potentially. We can have that debate in the Duke of York.
Yeah, we can. Very quick word on technicals. Do you look at the chart at all?
Sure. I tend not to, but I've learned over the years, I've worked in a number of banks where they have some great technical analysts who do some very, very good work, and the best piece of advice I can give is look at the fundamentals, but absolutely make sure you're keeping your eye open to the shorter term technicals as an overlay to that in terms of a decision timing as much as anything.
Gentleman at the front, thank you. Good question. And then we've got one over there and then one right at the back.
Yeah, I thought I'd ask you a question about sectors. I'm trying to work out how do you decide which sector to invest in on the basis of historical performance. So you have, what's done best over 1, 3, 6, 9, 12 months. If you invest just after the ones that have done best over 1 month, it might not be such a good idea. So can you give us some clues on your strategy to choose the best sector in the future?
Gareth?
Well, I've been a TMT analyst for most of my career, so I love the tech sector. I think that the tech sector is a fantastic long-term opportunity for a number of structural reasons, the relatively low levels of capital that need to be applied, the huge scalability, as Russ was describing, some of the models that can be built are fantastic. But looking across sectors, I think it's more a matter of trying to find those characteristics where you see them in the different management teams, the different business models that you're looking at, and importantly, looking to the longer term, and looking, a lot of the comments that you've seen from Charlie Munger and Warren Buffett and people, they look for the long haul. They look for the demographic shifts which aren't going to change. They're not going to be oscillating around 6 months this, 6 months that. Over the long haul, things like healthcare, the current strong performer, obviously healthcare is going to be a beneficiary of the demographic changes that we're going to see over the next 5, 10, 50 years. Those sorts of things are great trends to go with. Sure, you might want to take a short-term sector bet against that or on a cyclical basis, but if you've got long-term structural change on your side, I think that has to be a major help.
Michael?
Yeah, I mean, I would agree with that. Certainly, the house building sector is a great case in point. We suffered a calamitous fall in 2007, 2008, and everyone was pretty much writing off the house builders. There was an awful lot of consolidation in 2009, 2010, and now that sector has gone on a massive tear. I'm just looking at the one-year performance on a stock like Taylor Wimpey. It's still £1.99 a share. It's up 77%. So that would suggest to me that probably that's near a top. But then you look at the overall supply and demand of the sector over the course of the next 3, 4 or 5 years. We can't build houses quick enough. So then you take a long-term view on interest rates. What's going to happen there? So, what I would suggest with respect to the house building sector, I wouldn't buy it now, but I'd look for a pocket of weakness, watch the shares come down, and trickle money in over the course of the next 3, 4 or 5 years.
I think it comes down to pricing power and barriers to entry. So everything that applies to individual stocks, I would say applies to industries as well, would be my suggestion. Airlines can be great stocks to trade, but over time they've been tremendous destroyers of capital because they've got very, very limited pricing power.
They're also very choppy and very, very exposed to the ebb and flow of oil prices.
No control over their cost base, apart from the short-term hedges. So I think those are the things that you're looking for. Can they control over cost base, control over the pricing they can charge their customers? And in an internet world, what you can charge for your customers has never been more transparent. It's never been harder in that respect. So that does add a different dynamic to it. Does that help at all? It's a good question. There's a question from a gentleman here, please.
Your energy sector, which is the bottom one, is that a good time now to get in? Because you have a lot of your green flag companies in there, Shell, BP and such like, but there are also red flags as well.
It's a very good question I got yesterday in an internal presentation. Is it time to buy the big oil stocks?
I'm a little bit suspicious of Shell. I think they might be overpaying for BG Group, especially now. But it's something that they needed to do to diversify away from crude oil and their older platforms in the Brent field, which obviously they're shutting down. So they're taking a hit up front. But if you actually look at the share price performance of Shell, for example, over the course of the last 5 or 6 years, hasn't done that much. It's traded sideways in a very, very broad range. So it's a decent dividend payer. As long as the dividend's not under threat, then I would suggest that you get near to the bottom end of that range, and I'd look to pick some up.
Technology analyst speaks on oil.
That would be dangerous for me to say too much.
Okay, thank you, sir. A question right at the back here, please.
I'd like to ask about portfolio management. I'm currently a new investor, and I want to know how many shares you should have in your portfolio. I've spoken to some people that it should be as much as 15, but I'd find that quite hard to keep track of 15 companies. So I was just wondering what your thoughts are on that.
I think if you've got a balanced portfolio and you've got, between 10 and 20, I would suggest, spread across the whole sectors, you shouldn't really need to look at them more than once a week if you've got a decent enough exposure. So we've seen, for example, a fall in the FTSE 100 and fall in stock markets in the last 3 to 6 months of about 1,000 points. I probably look at my portfolio once a month because I've got decent blue chip companies which I'm happy with, and I'm quite happy to hold for the long haul. I'm not really interested in what they do on a week-to-week basis. I'm more interested in what they're going to do to me over a 5 or 10 year period. So if you're an investor, as I say, I'm an investor, but I'm also a trader. So I have a different mindset for different types of investment, if you like. So for me, if you've got a very broadly balanced portfolio, you shouldn't really have to look at it more than, say, once a month. Once a week, if you're really that worried about it. I don't know what you think.
Well, yeah, I mean, I think we could read endless academic papers on it, but between 10 and 20 is generally held up as being the right number in terms of expense involved, in terms of buying them, and then, as you correctly said, the time and actually monitoring them and wondering, if something does go wrong, what do I need to do to replace it? That is probably optimal, so long as you've got a good geographic and a good sector spread. You've not got 12 oil exploration companies in there, none of whom currently generate any revenues. Gentleman there, please, and then another, and then probably one just in front. Thank you. Sir, yes.
Hi. Would the panel advise to invest in either the growth shares or the income shares?
Growth or income, I think, depends entirely on your own personal circumstances and requirements.
I tend to be more slightly risk averse, so I'll probably have 70-75% income and say 25% growth, simply on the basis that I want to preserve my capital and grow it. Now, if you want to take a slightly more pro-risk approach, then you might sort of adjust that balance the other way. But it's entirely a matter for you. There's no holy grail when it comes to investing. It's entirely a matter for your own risk aversion, if you like.
Yeah. I think that's spot on. I mean, my perspective would be that maybe you want to have a different strategy across different sectors. If you're looking at certain sectors, you probably want the income and stability that goes with those, or should go with those, if those businesses are being well run. In other sectors, higher growth, more higher beta sectors where you're looking for more risk, you're looking for more return, then if you restrict yourselves to stocks which have high levels of income, then you might be missing out on the best stories. Certainly in the TMT space, if you screen stocks for a dividend, for example, then you're going to struggle to find some of the most exciting stocks in the sector. So I would say an approach that varies sector by sector might be the right way.
Question over on the right, and then we'll come back to the middle, please.
Hi. Post-2008, it was a topsy-turvy sort of landscape, and I remember an awful lot of there was a trend in the broadsheets in particular where there was a certain economic theory had a lot of reporting, which was basically that the Western world would slow down to a rate of growth, and that the rate of growth seen over the last 10, 20, 50 years was unusual over very long-term periods. In terms of a macro sort of question, do you think 2, 3, 4% is still sustainable as a growth rate for established GDP countries? Because it will impact on economic activity.
In the Western world, you mean? Or more broadly?
Well, you know more than I in terms of where FTSE 100 companies earn their revenues.
No, absolutely. Well, I think, if you take China out of the equation and probably the emerging markets, then I think the days of 3 or 4% growth are pretty much behind us, certainly in the UK and the US. Until you clear the large debt overhang that actually sits over the economies in Europe, UK and the US, I think you're going to struggle really to get much more than 3% growth going forward. Now, I know we got growth numbers out of Ireland this week in the region of 6%, but that was from a very, very low base and a massive wipeout from 2008. So it really depends on the demographic factors or the geographical factors where you're looking, but I certainly think on a global basis, probably 4% is about as good as it gets if you include countries like China, because the low-hanging fruit is pretty much gone from the beginning of this century, and now it's really a question of where the new markets are. And I know a lot of people are looking at countries like India.
Yeah, we've got the IMF World Economic Report coming out next month, which will be interesting. They're hovering at around 3.5 trend at the moment, I think. I'm sorry to say we're out of time. I know we've got one more question. We'll try and take you afterwards, sir, but we've got to get ready for the next session. So everybody, a very big round of applause for Gareth and for Michael, please. And thank you for your questions.